Okay, so just do this cash production budget from the 2016 Examcraft mock. So it's January to April in effect. The May and June are just going to be used for part one and part two. So cash production, as I always say, it'll always tell you it's either budgeting or budgeting. It's actually a mixture between the two of them. Um, first two parts will be like a budgeting question, and then the second two parts will be like a cash budget. It's quite straightforward, but they take a little bit longer, I'd say, than the other ones. So just be aware of your timing. Maybe it's not the best one to do if you get to the end of your mock or end of your leaving cert, sorry, and you're a little bit short on time. That just might be me, of course. You lads might be a lot quicker. So part A is prepare a production budget for the 4 months, January to April. Now you'll see I've gone as far as June in this. You need to go as far as June for close to calculate closing stocks. Now we'll see that as we go. So a production budget, as you know, is sales, less opening stock, add closing stock. So that's what a production budget looks like. You know that from doing budgeting questions. And your answer then is your production in units, which will guide us elsewhere. So this is all in units. So the sales are as given here. So 5,000, 6,5. For March it's 7,000. April it's 8,000. Now I have to keep on going, even though it only asked me to go to April. I have to go 8,5 here, and for June it's 10,000. Now, our opening stock. Just be aware that Zach Limited is preparing to set up a new business, so it doesn't have the business, so he has no opening stock. So then, what to tell us about closing stock? Well, the first number one, the product requires 6 kilos of material T, which costs €3 per kg. That's nothing to do with closing stock of finished goods. Number two, stock of finished goods are 60% of the following month's sales requirements. So we're always going to keep 60% of what we expect to sell the next month. So our closing stock, therefore, is 60% of the next month's sales. So for January, it's 60% of February sales, which is 6,5. For February, it's 60% of March's 7,000. For March, it's 60% of April. For April, it's 60% of May's 8,5. And for May, it's 60% of June's. Okay, June, you can go no further than that. So then, our opening stocks. Whatever we finish January with, we start February with. So if we finish January with 3,9, we start February with 3,9. We finish February with 4,2, we start March with 4,2, and so on. So finish March with 4,8, start April with 4,8, and finish April with 5,1, start May with 5,1. So that gives us our raw materials, our production budget. So just do your sums. 5,000 plus 0 or minus 0 plus 3,9 is 8,9. 6,5 minus 3,9 plus 4,2. So it's always less opening stock, take closing stock. 7,000 minus 4,2 plus 4,8 is 7,6. 8,3 and 9,4. Okay, so that's part one done. Part two, prepare raw materials purchases budget in units and euros for the 4 months, January to April. So this is how many units or how many kilos of raw materials we have to buy and how much it's going to cost us each month. So it's like a raw materials purchases budget in budgeting. You take your answer from the first part. So, and we take those as your starting point. So 8,9, 6,8, 7,6, 8,3, and 9,4. Okay, they're your starting points for those. Now, in normal budgeting, there's normally like two materials, material X, material Y, and you'd be multiplying them both out, and you have two columns on the go. In this case, there's only one material T. We're only making one product, so it's 6 kilos, Uh, the materials in kgs needed are 6. So we just multiply them out, and that'll give you the total materials needed. So 8 9 by 6, 6 8 by 6, 7 6 by 6, 8 3 by 6, 9 4 by 6. Just multiply them out. All right, and that'll give you your materials in total. Then you go back to your less opening stocks and add closing stocks. So exact same process as part A. So new business, so no opening stock for January. There's nothing to say it doesn't have to be. It has to be new business. Then, like I suppose, in some question, they could give you some information that's not a new business, but you'd work that out yourselves. The closing stocks then. This time it tells us that stocks of raw materials cover 25% of the following month's requirements in kgs. So it's 25% of, for January, it's of February. So 25% of 40,800. For February, or for February's closing stock, it's 25% of the 45.6. For March's closing stock, 25% of the 49.8, which is 12,450. And then for April's, it's 25% of 56.4, which is 14.1. At that point, you can stop. You don't have to go into May. Okay, it's the same process then. Whatever we finish January with, 10.2, we'll start February with. Whatever we finish February with, 11.4, we'll start March with. Whatever we finish March with, 12.450, we'll start April with. And we can stop at that point. We don't have to go into May. Okay, so that will give you your required purchases in kilos. So same thing. Materials in total, less opening stock, add closing stock. And I'm just going to quickly go across them. Okay. The price per kg, it tells us is €3 per kg. So we're going to take each of those numbers, we're going to multiply them by 3, and that will give you the required purchases in euros. Which is what we're also asked to find out. So we'll take the 63.6, we'll multiply by 3, and that'll give you 190,800, 42 by 3, 46,650 by 3, and 51,450 by 3. And they're really important. They're going to be used in our cash budget. Okay, so 190,800, 126, 139,950, and 154,350. Okay, so from that point on, you're moving into cash budget territory. So part C is prepare a cash budget for the 4 months, January to April. So cash budget, we've got our receipts and our payments. So our receipts are our cash collection from sales. It tells us 30% of cash is for immediate of sales is for immediate cash. So cash sales, 30% of sales, where a 4% cash discount is allowed. So in effect, it's 96% of 30%, which is 28.8%. So that's a strange number to go, but anyway, it is 28.8% though. So 0.96 by 0.3 is 0.288. So we're finding 28.8% of each of the sales revenue numbers. So you'd notice the mock because they throw in mad numbers like that, and they probably didn't put a huge amount of thought into it. So it's 0.2 88 by 175,000, 50,400. 0.288 by 227,500 is 65,520. 0.288 by 245 is 75,60. And then we've 0.288 for April by 280, which is 80,640. So that's our cash. The rest of it is our credit collection. And it tells us we're collecting 70%, half of it 1 month after. So nothing in January. So half of 70% is 35%. So 35% of 175,000 gets collected, of January's 175 gets collected in February. There's no discount involved there, I don't think. Didn't actually read on. Yeah, there's not. So 35% of February's 227,500 gets collected in March, and 35% of March is 245,000 gets collected in April. Okay, the 2 months then, the remaining 35% gets collected. So January's isn't collected in January or February, it's collected in March. So 35%, same number, 61,250. And then February's gets collected in April, so it'll be the same as the 79,625. Okay, so some of January is collected in January, some is collected in February, some is collected in March. You don't have to go beyond that point into May or June. Just total them up. Okay, so that gives us our total receipts. Now we're on to our total payments, and it's really important you don't skip this one here. 1 month's credit is received from suppliers. So your 1 month's credit received from suppliers is you have to pay for these kilos that we're buying. So these are our suppliers here. We're collecting the money we're paying the money 1 month after. So that's purchases of supplies. Nothing in January because you're getting 1 month's credit. The January 198,800 from there, that's what we're buying. That gets paid for in February. The 126 from February gets paid in March. And 139,950 gets paid in April. Okay. And that's us up to date on the purchases of supplies. So we move on then to the next one. Wages are payable 22,000 a month. Nice and easy. We'll just put in 22,000 in each month. Variable overhead, €6 per unit, payable as incurred. So €6 per unit. These are the units here, back up all the way to the top. So it's 6 by 5,000, which is 30,000. Oh, it's not. God, don't make that mistake. It's 6 by 8,900. So it's the units, the answers from part A. So 6 by 6,800. 40,800. Then it's 6 by 7,6. And 6 by 8,3. And the reason it's the amount it's from here, it's per unit produced. So this is the amount, this is the number of units we're making, and we have to pay €6 in variable costs for every one we make, not every one we sell. Fixed overheads including depreciation, 20,000 a month. So you never include the depreciation. All right, so 20,000 a month, you don't include them, so you have to work out what the depreciation is. the depreciation is on the equipment that we buy. So you buy it in January and paid for in February. See, that's a strange one. Purchased in January and paid for in February, costing 36,000. Has a useful life of 8 years. So 36,000 divided by 8 gives you the depreciation for 1 year, which is 4,500. Then you have to work out how much that is per month. So per month it's 4,500 divided by 12, which is 375. So the 375 is not included. Okay, so we have to take the 375 out of the fixed overheads. So 20,000 minus 375 is 19,625. That's every month. Okay, it's a fixed overhead. So that's our fixed cost. Then we go on to our capital costs. Got the equipment. Now, if you do what I normally do, which is just read the first thing and then do nothing, you would have made a mistake here, because it says equipment will be purchased in January, and if you just saw the 36,000 and put it in January, you'd be wrong, because it tells you it's paid for in February, and this is a cash budget. Doesn't matter when you buy it, it's when you pay for it that we're interested in. So the 36,000 goes on to February, zero in the other months. To pay to finance it, you got a loan of 30,000, which is secured on the 1st of the 8th or 1st of February. So you don't have the loan in January, you have it in February at 8% per annum. Interest will be paid monthly, but capital repayments don't start until August. So you don't have to worry about loan repayments. We just have to worry about what the interest rate is, or what the interest is. So that's 8% per year. So it's 8% of 30,000 gives you a year's interest. We have to work out what it is per month. So per year it's 2,400. So per month it's 2,400 divided by 12, which is 200. So that 200 euros interest gets paid every month. So from February. So you have three of them. Okay, that's our loan interest. So that's all of your costs. So we can finish it out from that point. So add up your expenses, your expenditures even. So did I? Oh. Again, there's me rushing in. See here, wages. Going way back to this, you're probably shaking at the screen seeing this. Wages 22,000 per month, payable 1 month in arrears. I'm just after seeing that now. So 1 month in arrears means you pay you pay January's in February and so on. So there are no wages in January. So the rest of them, that doesn't affect the rest of them. So it's 73,025, 309,45, 213,45, and 231,575. So that's your total payments. Take them away to get your net cash. So take them away from your total receipts. So 126,770 minus 309,425, 211,435 minus 213,425, and 246,015 minus 231,575. Okay, you've got your loan, opening cash, and closing cash. So the loan you got on the 1st of February was 30,000. So let's throw that in there. Your opening cash is zero. So your closing cash is minus 22,625. No loan to add on, no opening cash to add on. So it's minus 22,625. You need to bring that up then to the next month. So then it's net cash plus loan plus opening cash is closing cash. So minus 182,655 plus 30,000 minus 22,625 is minus 175,280. Bring that up to the next month. And again, total them. So 213, minus 1990, no loan anymore, minus 175,280 is minus 177,270. And again, finish that off by minus or 14,440 minus 177,270 is minus 162,830. So I'll take from there out. So we've the last part to do then, which is the budgeted trading profit and loss account. So that's our sales as far as gross profit, and then take away our expenses. So for sales, doesn't matter that there's discounts or anything like that. It doesn't matter that you're paying for stuff. Sales is just the numbers added together from for the 4 months. So it's 175 plus 222,500 plus 245 plus 280, which is 922 922,500. Is that right? 175,227. All right. Cost of sales then. Opening stock, 0, new company. Purchases, 4 numbers added together from part B. So the 190,800, 126, 139,950, 154,350. That's the amount of stuff you're buying. That's 611,000. Your closing stocks. Now there's 2 of them. This is from a previous question. So you've got finished goods and raw materials. So your closing stock of finished goods, and tells you the price in the brackets here, that's really important, is 18. Your finished goods in units is your answer from part A for April, the 5,100 and it's going to multiply by 18. Okay. Your closing stock on raw materials, well, we know the price of raw materials is €3 per kilo. And for part B, we know the finishing stock of raw materials is 14,100 in April. So it's 14,100 by 3, which is 42,300. So we'll add those together. Two of them added together, and remember they're minuses. So it's opening stock plus purchases minus closing stock, which we'll take away is 477. So your gross profit then is those put together. Our expenses. Now, our expenses are all of these that are listed here. There's a couple of things we have to be really careful in here. The first one is that if there's a discount allowed, that we include it. It's pretty much all, well, there is in the mock ones anyway. There's always a discount allowed. So we know that there was a 4% discount on cash sales. So it's 4% of 30% of our sales of 927,500. Which is 11130. Our next expense is wages. This is where it's important to know the difference between a trading profit and loss account and a budget, a cash budget. It tells us it's 20,000 per month. It doesn't matter that 1 month is payable in arrears. It's still 4 months of 22,000. You remember that accruals concept? It's not when you pay for stuff. It's it's when they're accounted for when we're doing trading profit and loss accounts, or when they happen. So it's 88,000 for our wages. Our variable overhead. So a variable overhead was €6 per unit. So it's going to be 6 multiplied by the number of units. So the number of units are 5,000 plus 6,5 plus 7 plus 8. So 5,000 plus 6,5 plus 7,000 plus 8,000. I'm just showing you this way. You don't 6 by. You don't have to do it that way. There's a you can just add up the variable units from the cash budget and you get the same thing. So that's 26.5 by 6. Sorry. So I put that in the wrong. So that's 1.5. I've added that up wrong, haven't I? It has me given it. Oh, sorry, what am I doing? I apologize. Don't do it that way. Just ignore everything I've said. Obviously, the variable overheads weren't per the sales. I made the exact same mistakes I made earlier on. It's per it's by the units produced. So if you want to multiply them that way, it's by 8.9 by 6.8 plus 7.6 plus 6.3 by 6. So I'm just going to add the 4 numbers up there to be easier for me at this stage. Sorry, that was stupid. I don't know why I tried to do it that way. So that's 189,600. The fixed overhead is 1965 by 4. We've got depreciation, which we know is 375, which is 1,500. So that's all of them. We've got our loan interest to put in, but we always know that goes in after. So we'll take that away and we'll get our operating profit. And to finish it off, we're going to take away the interest. And the interest was 200 a month. So that is €600. And that gives you a net profit of 81,170. So last part then, it shouldn't be for too many marks, I wouldn't think. The advice for Zach Limited, always try and give I would say 3 pieces of advice. 3 or 4 pieces of advice I might have found. That's pretty much guarantee you that you've got everything covered. So the first thing is, well, what advice can we give? Can we give any advice on their stock levels? So are they keeping too much stock? So they're keeping their closing stock at 60% of the following month's sales requirements. Is that a bit too much given the money they're spending? It might well be. So they're aiming, they look like they're going to make a profit of 81,170, but their cash position is minus 162,830. That means they're over trading on this a bit. So you can say they're making a profit of 81,170, but their cash position is minus 162,830. So they're over trading. They need to try and reduce their bank overdraft by keeping less stock, keeping less raw materials, by getting more cash in immediately, by extending credit terms, look for try and look for 2 months credit from their purchases. Um, what else could they do? Uh, they might need to borrow money. They could negotiate a bank overdraft, anything like that. So look at because if you just look at any of these parts, so what can we say? Well, in this area here, they need to try and get more of this money in quicker. So they could maybe only offer 1 month's credit, and then all of this money would come in a little bit quicker, and they'd certainly have a better position in February, March, and April. On the payments, they could try and arrange 2 months credit. Uh, on their loans, well, what could they do? They could push their loan out over more years, so it's their uh, well, they're not making any loan repayments at the moment, but say if they were, that gets us to their closing cash position. But what could they have here? Well, they could try and extend the bank overdraft. So they're the types of things you're looking for. Always try and get three of those down. Okay, lads, we'll talk to you again.